Good morning, everyone. This is Dana from NexGen, and I hope everyone has had a fabulous week. Today, I would like to talk about the pros and cons of a home equity conversion mortgage. Now, a home equity conversion mortgage is one of three reverse mortgage types. So, we're going to concentrate on the pros and cons of the HECM. That's the acronym for it. Now, this can be said for all of the reverse mortgage types, but we're pretty much focusing on the HECM program. Reverse mortgages are designed to help seniors who are struggling to meet their financial obligations. Now, there are plenty of benefits to this program, but there are also some very serious risks to consider. Now, you might not have to make payments with a reverse mortgage, but there are other fees and expenses that are associated with this program. So not only do you have to keep up with the taxes, insurance, and HOA fees, but you also have to pay an upfront insurance premium. And we'll talk about what that insurance premium does. Usually this is 2% of your home's appraised value. You'll also pay originating fees at closing. You do have the option to roll these costs into your loan balance, but that means that you'll just receive less money. Now, reverse mortgages are ideal for retirees who don't have a lot of cash savings or investments, but they have a lot of equity built up in their homes. And we talked about home equity and what that means. So a reverse mortgage will allow you to turn an asset that usually is not liquid into cash to cover your expenses in retirement. So normally, the home that you live in is not liquid unless you sell it. So instead of having to sell your home to liquefy your assets, you can keep the property and still get cash out of it. This means you don't have to worry about potentially downsizing or getting priced out of a neighborhood if you have to move. So to qualify for a reverse mortgage, you must be able to pay your property taxes, homeowners insurance, HOA fees, and other costs. That's HOA fees if it's applicable, and the costs associated with owning your home. You'll also be required to live inside the home, and it has to be your principal residence for most of the year. And I'm going to include the link to the HECM program because things are changing all the time. But if at any point during the loan period you become delinquent in any of the expenses that I just talked about, or you spend most of the year living outside the property, you could default on the reverse mortgage and lose your home to foreclosure. And we'll be talking about ways that can happen. Now, your home doesn't have to be paid off to take out a reverse mortgage. Now, usually what they do is they use the proceeds of the reverse mortgage to pay off an existing home loan. And this will free up money that you'll get to put toward other expenses. On this channel, we promote generational wealth. And for most people, home ownership is their path to building generational wealth. However, a reverse mortgage usually requires the home to be sold to repay the debt. So the reverse mortgage, again, is a mortgage. So that is a debt. So when you die, the heirs will be required to pay the full balance, or 95% of the home's appraised value, whichever is less. And that's important. This usually means selling the home or turning the property over to the lender to satisfy the debt. So, not to mention, reverse mortgage eats away at your home's equity. So by the time it needs to be paid off, there may not be enough equity left to pass on to your heirs. Now, in some cases, the value of your home could end up being less than the total amount owed on the reverse mortgage. It's basically upside down. If this happens, then the heirs don't have to worry about paying the balance. So it'll be 95% of the home's appraised value, or the full loan balance, whichever is less. But if the home is upside down, then the heirs don't have to worry about paying the balance. So according to the IRS at this time, the money that you would receive from a reverse mortgage is a loan advance, and it's not income. That means that it's not taxed, which is different than the taxing of retirement income, such as the distribution from a thrift savings plan, a 401k, or an IRA. However, a reverse mortgage may not be considered, even though the reverse mortgage is not considered for tax purposes, it could impact your ability to qualify for other need-based government programs, such as Medicaid, or it's called Supplemental Security Income, or SSI. So it's a good idea that you have a conversation with the benefits specialist to make sure that your eligibility won't be compromised. So you'll be talking to, if you take out a HECM loan, you'll be talking to a counselor, plus you would also be talking to a benefits specialist to make sure that there's not a conflict. So as you can see, there are a lot of rules and caveats to reverse mortgages, and we'll be discussing them in this month. So these loans come with many risks, and it may not even be worth getting the cash out, the extra cash. So it's best that you understand the terms and conditions. It's in your best interest. Now, you're probably asking yourself, should you even get a reverse mortgage? Well, for what it was intended, it's helpful, but again, it's not for everyone. So there are a few things that you would need to consider before you even know if having a reverse mortgage is worth it. The first thing is your home increasing in value considerably? Because remember that with all of the money that has been lent, plus the interest that is being accruing, you want to make sure you have enough money left over in your estate. The next thing is, do you plan to stay in your home for a long time? Now, when you consider, especially when dealing with the HECM, with all of the upfront costs that's associated with the loan, you want to make sure that you get the benefit of the reverse mortgage by being in the home long enough to make those costs worth it. Then the last thing is, and I would think one of the more important things, is can you cover the cost of your home? The reverse mortgage only defers the principal and the interest, the loan amount plus the interest. You would still be responsible for the property taxes, insurance, maintenance, and anything else that's required to keep that reverse mortgage current. And you want to make sure you have enough cash flow to cover these costs. Thank you for stopping by. I hope the information was beneficial to you. In the coming weeks, we're going to be talking a little bit more about the home equity conversion mortgage, but I wanted to let you know that this program is always changing. So I put the link to the program in the description below, along with some additional information. So thank you again for stopping by. Don't forget to like, share, and subscribe to the channel. And I'll talk to you next week.